What's going on, guys? Welcome back to another video. Today we're going to be talking about how to avoid getting stopped out on your trades. Now, I've already tried to make this video 3 or 4 times and have failed to do so properly because there's so much information and so many different approaches we could take in regards to teaching how to avoid getting stopped out given one circumstance over the other. So there's a lot of what ifs and different scenarios that we could teach, and that's why I can't combine it all into one video. So there's going to be multiple videos on this topic, and I'd encourage you guys, after watching this one, continue to watch the next ones and the following videos that I upload on this topic of stop losses, because it's going to go through multiple different examples and different scenarios where it might work better to put a stop this way rather than this. And we can't get that all into one video. It's got to be broken down into multiple videos so you guys can piece it all together. But by the time you get done watching the whole series on stop loss, you should have a really good understanding. And then before we get into it, as always, hit the thumbs up button because, again, this is like the 3rd time I've tried to make this video today. All right, so let's get into it. Number one most important thing to avoid getting stopped out, I know this is going to sound childish, but it is literally the truth of all truths, which is make sure that you're buying the right setup, or make sure you're buying a stock that's going to go up. Or if you're a short bias, make sure you're going to short a stock that's actually going to go down. Because if you buy into something that actually isn't meant to go up, then it's going to go down and you're going to get stopped out, right? Seems kind of childish, but it's pretty straightforward. If you're not buying the correct stock, or you're not buying the correct setup, or a stock isn't truly changing momentum to one side or the other, or truly breaking out, then you're most likely going to get stopped out. And if a stock isn't trending up, or if a stock isn't breaking out, then it's most likely going to be in consolidation. And let's show you an example of consolidation. Let's zoom out a little bit more. Here we go. So this right here, consolidating back and forth, up, down, back up, down, back up, down, back up, down, you'd most likely get stopped out. Buying a position here in a top consolidation zone, you'd most likely get stopped out. Buying into here, you'd most likely get stopped out. Buying into there, you'd most likely get stopped out because the price action is just going up and down, back and forth, back and forth, back and forth, back and forth. So if you were to take a position in any one of those boxes that I put on the screen, anticipating a breakout to happen, there's a great chance you would have been getting stopped out because of the duration or the length that it actually took for the stock to break out, right? Now, if you took a position here or, like here or here or here, you'd probably go through all these days and just get taken out, right? Because it didn't make the move you wanted to right away. Whereas if you bought right here on the low, or you bought right here on the low, or you bought right here on the low, you probably wouldn't get stopped out because basically as soon as you enter, it's going in the right direction. So always remember that the most important thing to not getting stopped out is correctly picking an entry that is very favorable, that is most likely going to move in the direction you would like instantly. Remember that. But again, that can sometimes be very hard, okay? So let's take a look at AMD. We're going to view it over the course of 20 days, and we're just going to put it on a 1-minute time frame. Okay, I'm going to go all the way back here to this day. So remember, as I said, if you picked the right or perfect entry, you most likely wouldn't get stopped out, meaning if you were to buy this absolute low, the likelihood you got stopped out on that day, not going to happen. Right? Whereas, let's say you picked this entry on the day over here, you picked to get long here, we push up, we come down, you'd get stopped out there. And then the following day, it goes on a rip and you'd be like, what the hell? Okay? And that's a perfect example of people getting stopped out, where they would buy into something, and then later it kind of comes down, knocks them out, then maybe goes back up, then the following day jumps around, then it goes on another rip, and then all of a sudden it keeps going up, and you're like, oh, I'm missing all this move, and I'm getting stopped out, okay? So how do we avoid that? Okay, so in this video, we're specifically talking about how to avoid getting stopped out while trying to catch the overall trend on the day or over the course of maybe a couple days, turning it into a swing trade. We're not talking about how to properly put in a stop loss to avoid getting knocked out in regards to maybe a momentum trade or a quick day trade position. This is more or less trying to catch the overall trend, okay? So let's do this, okay? We got to first talk about it, and we're going to use this day as an example. We're not going to use this day because this day is just too perfect. It's just breaking straight up, so it's not the best example day. But let's take a look over here on this day, okay? What most traders would do is before they decide to jump into a position, they want to see the stock trade on the day, maybe 10, 20, 30, 15 minutes. That's kind of like the go-to time to really get a good understanding of which way the stock's going to go on the day. You could trade the first couple minutes. You can trade within the first 30 minutes of market open and make money and trade. But again, more oftentimes than not, after about 25, 30 minutes of trading, you're going to get more character, more formation. The chart will tell you more. You'll be able to read it a little bit more efficiently, and it's going to tell you a bigger story, which can be easier to predict the overall trend on the day. So in a scenario like this, or a day like this where AMD is trading, we see it open up on the day, goes down, then it bounces, and it does this, does a double bottom, comes all the way back up. Then it kind of does a little pullback here and then creates a breakout. This is arguably like a cup and handle. You had a double bottom and then it breaks out, okay? So with it going down, up, down, back up, all the way to highs and breaking out, most people would be able to recognize this as a good long position right about here, okay? Or they'd understand what's going on probably right about there in that time frame. So most people would end up taking a long pretty much, not exactly, give or take, but for simple terms on the video, most people would probably get long about right there on that setup, okay? Where they're pretty much getting long, over that yellow line, okay? If you were to do this and you're trying to catch the overall trend on the day, and let me take a step back, if you did enter right at this line and at that arrow, and then the stock actually goes up and it starts going up a little bit and a little bit and a little bit, so it's actually going in your favor, at minimum, you would have to have a stop loss at this red arrow, your entry. At minimum, you'd have to have a stop loss right here. Why? Because when stocks break out of, a position or a pattern on the day and they're actually starting to break out, normally if this breakout's going to be true and it's going to be successful, the price would normally have to stay above the breakout level, which was right where you entered. It would normally have to stay above that line. If it goes below, there's a good chance that it's either not going to trend on the day or it's going to give you more of like a pain in the ass headache day. And if it's going to give you more of a pain in the ass and headache day, then it's probably not trending. The stock, the overall stock on the daily chart on a bigger time frame, it's probably not trending, or it's not in the best or most prime situation or setup to have a breakout move or a trending move just yet. So taking a step back, if you're to get in, your stop at minimum would have to be your entry price, okay? And at most, you would want your stop at the low of the day, like here or here, at most, okay? Because if the stock does successfully break out, right, and it starts going up, it's trending up, what's the likelihood that that stock's going to come all the way down back to low of day? What's the likelihood a stock does this, breaks out, does this, and then goes all the way back down? Not very likely, especially if it's a well-known company like Advanced Micro Devices or Apple or Facebook. The likelihood a stock does that, pretty much not going to happen unless there is some type of catastrophic news event that hits the stock while you're in your trade, or some type of catastrophic event happens globally and the overall market gets smoked, or the economy crashes instantly, or something crazy happens. That won't happen to you. What will happen is this. You take a position here, kind of get in, and maybe you buy some here on this pullback and you keep your stop loss like right here, right here. Yeah, there's a good chance it's going to go like that, take you out, and then go back up, right? That is very likely to happen. Or You take a position all the way up here on the day. Again, remember, here was the start on the day. And now you're buying all the way up here on the day. If you buy up here and you buy a dip here, yeah, we come up, stopped out. You buy this dip, goes up, it comes back, stopped out. And that's partially because you're buying a high price on the day already. So just know that the higher something goes up on the day, the greater the chance you have of getting stopped out. Because if it doesn't truly just keep trending up all day without any sort of serious pullback or correction, right, then you'd be fine. But in most scenarios, in most cases, when you buy high on the day, that stock will have a correction on the day. It will have a pullback on the day. And if you bought all the way up there on the day, you're probably going to get stopped out. So for one, it's important to understand it's your entry that matters. And then two, being realistic with how stocks perform and trade on the day. And what do I mean by being realistic with how stocks trade and perform on the day? Realistic is stock does this, goes like that, goes all the way up to here on the day. It's most likely not going to do that. So how do stocks most likely and more oftentimes than not trade? Not like this. They don't normally do that. So if you have a stop all the way down here at low a day, you're probably not going to get stopped out unless you truly are wrong. Something catastrophic happens on the stock. And I'll show you an example of this when it does actually do that. And there's times when that sort of scenario will happen. And if it is happening without any catastrophic news event, then it's because you're buying the top and it's ready to top out. But if you're buying the low and you're buying the bottom, that scenario is not going to happen to you most likely. Okay. So also to recap here, when I said that your entry, most people's entry would be right around here, and the stop loss at minimum would have to be here or towards low of day, or pretty much just in this zone right here of these candles. The reason I say that, for one, is because if everybody is buying right here and everybody truly is buying this stock up right here because they think it's going to go higher, the last thing that they're really going to want or going to try to let happen is they're not going to allow this stock to start coming all the way back down and going through their buy zone. They don't want that. Nobody wants that. All right, so think about this. Your entry is yellow. Your stops at minimum would be here or like down here. And then also, what else do we notice significant about that? When does all the big buying volume come in? You see all this buying volume? When does that all kind of come in? It comes in here and at the breakout. That's where all the big buying volume comes in. So if you don't want to get stopped out on the day after getting in your position, this is trending up, then you're going to want to have your stops appropriate to where everybody was buying on the day. Because if you know where everybody was buying, then you know where the support is. And if you know where the support is on the stock accurately, then the likelihood you get stopped out will be far less. So with everybody buying here, you know that this is the appropriate stop out level for your trade. If you want to catch the trend on the day, then you have to be willing to keep your stop loss in relation to where the buyers were on the day. Even if the stock goes up, right, to a certain point, you may not want to move your stop out of that level, okay? Now we'll go take a look at a couple other days. All right, so let's go over to the following day. All right, so for most people, most people, they would be able to understand that this is probably a long on the day as the stock starts to break over this high point on the day. You can recognize entries and positions to take well before this level. You can, and we could talk of that, but we're not going to right now. But most people would be able to identify this as kind of the breakout on the day and where they would most likely take a position, right? For more skilled traders, they'd be getting in down here and before that point for the long play. But for the average trader, you're probably going to be recognizing it as a long play at this point, right around there. So what do we notice that's significant or has in common with the previous day that I showed you on AMD? Is that all your significant buying volume starts really coming in, maybe not that one, but starts really coming in at that high there, and as it's trending nicely and breaking out of the high a day mark. That's where all the volume starts to come in. So if this stock truly wants to trend higher in the day or continue into tomorrow, well, let me rephrase that. If this stock truly wants to trend higher on the day, then the likelihood of it coming or going up here and doing all this and then coming back down below the significant breakout or the buy points here is not going to happen. If the price does come back down there by some means, the likelihood that people start buying into it down there is very good. Very good. All right, so that's what it has in common with the previous day. All the significant buying volume is where most people would recognize this as a long, and they're not going to want to let that stock break below that level for the rest of the day. And as you can see, it ends up trending higher. So in a situation like this, on this particular day, if you wanted to catch the trend for the day and you started to take a long position over that high on the day, look at this, and you'd even get stopped out by doing the minimum. If you put your stop there, you'd get stopped out. So what I said is, you would take an entry. Most people kind of do an entry over this high, and your stop loss would have to be at minimum your previous breakout level, which would be this high. So if you put your stop loss right there, what happens? You get knocked out, but it didn't actually break down. It respected that level, and you can see we got bought up again, and we went ripping. So this is a common thing you'll see. A lot of traders will buy the breakout of the highs. It'll go well, and then all of a sudden it comes back down. They get stopped out, and it runs on themselves. That's a good that happens all the time intraday, and that's because a lot of traders, right? This is their psychology. Most traders would recognize this as a long. As it breaks over the highs, they would jump in, and as it pulls back, they would go, "Oh shit, it's going to go like this, and it's going to come down. I'm going to sell here before we get the big drop," and then it goes without them. But if you stay a little bit patient, right, you take your entry over this high, you stay a little patient. And again, in this scenario, if you wanted to catch the trend for the day and you kept your stop loss all the way down below low a day, right, so you buy here, it stops all the way at low a day, you'd never get stopped out and it would continue trending on the day. But the typical trader in their head would go, well, I don't want to have my stop loss all the way down here so that if it does do this and comes all the way down here, then I'm hoping it bounces all the way back up and does that on the day. I wouldn't want my stop loss to be all the way down there, because if I'm wrong, it comes down here and then it breaks here. I just took a monster loss when I could have cut it off right there. Absolutely right and correct way of thinking. But again, if the stock is bullish and truly wants to trend higher in the day, and you're not buying a bearish move or you're not buying a stock in consolidation, the likelihood it goes up to here and then comes all the way back down to there is not very good. And if it does start to do that and does that, you know that you're not buying the correct bullish move for the day. So in this scenario, if you were to buy this high and it breaks out, you'd want your stop, again, at minimum to be the previous high breakout. But you'd want to give it a second as it comes down and tests these levels. Just because it goes under, it doesn't mean it's going to break down. You want to wait to see how the candles close. So let me zoom in here, and that's something good to touch on. All right, let's look at the 1 minute chart. Okay, so let's zoom in. All right. These candles come down, we break the level, but you notice this candle closes above that level. And then the following candle closes just above that level. And then the following candle actually breaks down a bit, comes up, but still closes on that price. Next candle opens up, we jump over, and we have a strong close above the red dotted level. And now you can see we're holding back over that level. So traders are respecting the previous breakout level. Good chance it moves up and or higher on the day. All right. We've beaten this stock up enough on that day. Let's go to the following day. Does anybody start to notice something different, right? We go from trending up on the day, and now look at this one. Right? Remember what I said? Most people would recognize, the setup here is a little funky, but most people would recognize maybe this as a long over this high on the day or over this high on the day or something like that, right? But what happens, right? We actually break up in the beginning of the day, and then we get smoked all the way back down in the day below the low of day. Then we get bought up. We go for a move back to retest the highs. We start to fade away from those highs on a good bullish move. Then we go back up to over the highs, right? So let's say you get long. We break over. We come back down to test, right? So now let's zoom in and let's pay close attention. So we have the highs right here. Well, in reality, it's right there, but yeah, we're not going to go into that much detail on it. We don't need to. Okay, so we have the highs right here. The average person would say we're going over high of day. It's a long, maybe like the previous days we're doing. We press up. We come down. We do what? We bounce off the level. We hold above the level. Let me zoom in more. So we break up and over. We test it. We bounce, right? We hold above. We close above. We test it. We bounce. All right, but now you can see we're not really even bouncing. We're just kind of holding and holding and holding, but not creating a curl back up yet. Next thing you know, what happens? We break down. It doesn't instantly fall. Next candle actually goes above it briefly, then it closes below. Action down, okay? And so that would be a time where you go, okay, this is not holding, excuse me. You would say to yourself, this is not holding the high day breakout. We've came down, we've tested the level. It's not holding. I'm going to take that position off. Then what happens? It rolls all the way over on the day and gives back all of its gains. Remember how Connor said if a stock does something, well, not really like that, but it does something like this, goes up all day and then gives back all of its gains on the day, there's a good chance that you don't want to be long that stock on that day anymore. Or we could be seeing a shift in momentum to the downside to end the move to the upside. What happens the following day? You will see that we go into more of a bearish sentiment day. We start with a spike in the morning, then we get hammered down, and we were actually short bias on that day. We actually crushed it short, ready? Because the previous day, I seen this, right? The previous day, see, look at all this action, and then it just rolls over. We're going to think bearish on AMD for the following day. So what happens following day? We did take a few longs. We tested the long side, but then we flipped short on it. We're like, all right, the longs aren't going to work. We're going to go short. So we had like one long in here on this bull flag kind of setup. Didn't work. We're like, all right, we're probably going down. Short, 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 right? So did a bunch of shorts, did a couple little scalp longs, flipping the sentiment to the downside and catching most of that move down. All right. So then look what happened to the sentiment of the stock. We get a more of a bearish move. We don't fully break down. Look at the following day, right? Then the following day, it kind of gaps back up, and then now we're kind of holding again. So we just really went through a relaxation pullback. All right. So how to avoid getting stopped out in the day, right? So you get long here, okay? You get long here, and it goes up. Guess what? You're going to get stopped out on this day most likely, right? You would have got stopped out, even with your stop being at the previous breakout level, even with your stop being at low a day, you would have gotten knocked out. Why? If you followed that same sort of process, why? Because the stock is in more of a consolidation and pullback formation than it is truly trending up or breaking out. So you will most likely get stopped out on days like that where you're entering and taking a position on a day where it's not fully breaking out. Okay? So let's go over to a day where we're fully, truly trending and breaking out. Right here. Okay, so we kind of started, right? Let's just kind of take a step back. Right, so we kind of break up, we pull back. We're kind of doing this kind of couple day consolidation, up, down, back, up, down, up, down, up, down, back, up, down, kind of consolidating, right? So in the day where it finally picks its direction up and out, which we had one here, but we're not going to, we can discuss, we're not going to, right? So let's go over to this day. So you have your wedge snap break day, right? Or break move, okay? So most people, myself included, I'd be getting long on this position right there, kind of as this wedge breaks to the upside, okay? That's where I'd be getting long. All right, so if I get long here and I want to catch the trend for the day because I truly feel that it's going to trend on the day and the stock is actually breaking out, then I would want to have my stop on this setup because it's a wedge, right? I'd want to have my setup on this below this previous low or low of day. Because when you're breaking out of a wedge, you're not breaking out of a high a day top yet. That can come later. So my stop, there is no previous high top breakout level to confirm until it gets over it. So I can't get long here and just be like, oh, I'm going to have my stop here. That doesn't even make sense. It'd have to be below, right? So it'd have to be your previous low here or low here. And if you think it's going to truly trend on the day, then it shouldn't come back down and test those points. And if it is going to truly trend on the day or stay up, it would come down, test those points, bounce, and then continue back up higher. All right? So if you have your stops in here at low a day, you're never going to get stopped out on this day. And then the following day, we open up, we have a slight gap down, and it gets back up, and it goes on a big rip, okay? So watch this. For most people, they would see this high move here or high a day breakout here. That would be kind of their easy go-to setup where they would most likely recognize this as a bullish move, and they would start buying here. Watch what happens later in the day at that price point. We'll put one on the very top here, and we'll put one on the very top here. Ready? What happens? And let's delete this one so you guys can see it. Price action, right? Breakout. Most people would buy here all day. Slam. Right to your high a day price points. Holds above, bounce. So that there would be a very predictable bounce trade to take too. Okay. And there's even more that goes. There's a divergence there too. But anyways, so you can see that what happens, most of the masses or most of the public and people would understand that this is a breakout or the stock's going to have a good move over these high points. That was when it would become the most recognizable. Look at where all the most significant buying volume is, right there at that breakout point. The buyers are located here. That's where most of the buying was located. That price is going to try and stay above that level on the day, at least try to. Doesn't guarantee it will, but it's going to at least try to. So even if you get in, hold all day long, goes all the way, and then comes all the way back down here, you know that there's usually going to be at least an attempt to hold these prices. And the stock's not going to just go like that. Most likely won't just fall straight through. Thus, that gives you one more opportunity to test support, see if it can hold, and if it does, you're heading back to the green, and then you might be able to hold longer. Or you come down, it tests support, bounce, test support, and it's kind of fading, and then it breaks. You can take your trade there off, but you gave yourself all day and at least a test there to see that you're wrong. Versus doing something like this. Getting in here, right? And then putting a stop loss like right here. Or watching it go up and then putting a stop loss below that point. Because look what happens. It comes down, basically would stop you out there, would stop you out, right? So again, you have to put your stop losses to catch the trend on the day below or where most of the significant buying comes in on the day, because that tells you where the buyers are at, which tells you where the true support would naturally be at on the stock for the day. And that is generally how you go about keeping from getting stopped out, by appropriately putting in your stop loss correctly. See, most people would say to themselves after buying this breakout and the stock is all the way up here, to have a stop loss in all the way down there, they'd be like, that's just too far away. I mean, it's all the way up here and I may be up, let's just say $1,000 profit. And if my stop loss is all the way down here and the stock does come all the way down there and hit my stop loss, I'm going to go from $1,000 trade to no money. True, you will. But that's the correct way to stay in the trade. Nobody ever said, and nobody ever does, and ever will say that if you buy into a stock correctly and you have support on the stock or your stop loss mapped out correctly, that you're not going to shift from pretty much $1,000 green trade to maybe just barely green to maybe even slight red. You can have a correct trade and a correct stop loss in and still be red on the trade for a good portion or at least some point on the day before you go back to being green, and it can still be a great trade. So just because you buy at a good point and just because you have a stop loss in at a good point doesn't mean your trade may not go from 500 green down to $100 green to maybe 50 red before it goes back to a 500 green or $1,000 green. Okay? So another tip here before I head out and we finish up this video and wrap it up is that if, in fact, you get in and it goes all the way up here, and again, you're up $1,000 and you have your stop loss in the correct place, why on earth would you not sell like 70% of that position? If you had $1,000 green on the day from one trade, unless you had this idea of holding for like the next 4 or 5 days, but let's just say you're trying to catch the trend on the day and then maybe swing trade some, right? Why wouldn't you sell 70% of your position at $1,000 profit and then keep 30% with the stop loss wide as it's supposed to be in the first place? That way you feel more comfortable that you made a good trade, you took in a bunch of money, and now it's a free run. Those 30% of your shares, that position that's left, it's free reign to all hell break loose, run up to $1 million. I don't care. I'm already profitable on the trade and on the stock. So to me at this point, it doesn't really matter if it goes up or goes down because I've already won. And that is now position management while you're in a trade too. Okay? So that is kind of the first video that we'll go into discussing appropriating the right stop losses. That's more for catching the trend of the day. And then we'll go into more detailed videos about stop losses regarding kind of quick day trading and if you're scalping and in sort of scenarios like that. And also give you guys some kind of like tips and tricks along the way of what you might see, how candles might react at these certain price points that can help you kind of give you an idea that it's either going to continue staying in your favor or you might be seeing kind of like a fake out scenario. So I hope you guys like the video. I hope you learned something new. So definitely stay tuned to the next videos we do because we're going to be doing many more videos on the same topic. We'll talk about intraday trading. We'll talk about how to not get stopped out when stocks are in consolidation or recognizing when they're in consolidation so that you can be more mindful that if you do a stop loss, like we said in this video, you'd be more likely to get taken out and so on and so forth. So I hope you guys liked the video. I hope you learned something new today. Give the video a thumbs up before you're out the door, and I'll see you guys on the next one. Everybody take care and have a great day.